Something of a blockbuster year this year for American stocks, despite rising interest rates. And our guest sees the market keeping up this good run as we enter 2025. We're joined by Caron, Senior Portfolio Manager at Washington Crossing Advisors. Kevin, great to see you. Thank you very much indeed. So the stock's doing just fine. Well, up well over 20%. NASDAQ up about 30% or more this year, despite rising rates. And you don't see a pitfall for the market here or something likely to derail the market in the near term?
Well, in the near term, if you look at the data is supportive of a growing economy. So we're not looking at data that would be talking about investors pulling back. We're not looking at data that would show analysts cutting their S&P 500 earnings forecasts. We're not seeing anything in the data. In fact, our manufacturing economy here in the U.S., surveys of orders, they're picking up. So there's nothing in the data that shows slowdown. What we do point out, though, is that valuations are somewhat stretched. And when you think about mean reversion over time, it means that over the next 10 years or so, returns are going to be lower in our view. But there's nothing in the data presently that gives us pause.
And interestingly, we have heard that when the Fed starts raising interest rates, historically, it's not necessarily a terrible thing for the stock market.
Sure. So, right. So if the economy has a good head of steam, which the United States does, in fact, some would argue, I think rightly, that it's too hot because we've had some pretty significant inflation in recent years. The purpose of raising the interest rates is to get inflation under control so that monetary policy can be at least reasonably accommodative into the intermediate term and long-term future. And so that's what hopefully the Fed is engineering. They've tightened policy somewhat, but they still have more to go. And what we see with inflation coming down, the rate has come down. But when we talk to people here, the price level is still very high. So there's an understanding that there's more work that needs to be done. But the increase in interest rates was the initial salvo to begin to bring that problem to heel.
It's amazing. Your research highlights the incredible increase in the American economy since the end of, or since the first quarter or second quarter of 2009. Back then, U.S. GDP was something like just under 15 trillion. And now, for this year, it'll be almost 30 trillion.
Yeah, so a lot can change in 15 years. And when you look at the gains in stock market value and wealth in the United States, it's even more staggering. So as we sit here, we're looking at an economy that's got a good head of steam to it. Valuations have been marked up to recognize a lot of that. There is some question about longer term returns, and we definitely think returns are going to be lower going forward. But if you're looking for that shoe to fall, you're not going to find evidence of it in the data that we've been getting at least the last couple months. So we're near term bullish, but our longer term outlook sees the reality that we have come a long way in 15 years. And at this point, that kind of dynamism is not likely going to be the same for the next 10, who knows, for the next 10 or 15 years. But our general suspicion is returns are going to be lower.
You do see value in fixed income. You think bonds are reasonably attractive right now?
Yeah, so look at where we've been. So you spent most of the last 15 years with interest rates at or near 0%. There was an aborted liftoff in yields a few years back. But now that you've got yields across the curve up well above inflation here in the United States, that to us signals something of an opportunity. And so if you're really concerned about in equity valuations, and you're nervous perhaps that valuations have become stretched. We've hit $65 trillion in value in the U.S. equity market here. It was about 10 trillion back in 2009. That's a huge increase. So if you're worried about equity valuations, you say, well, where can I park some capital in the meantime and earn a reasonable rate of return? Bonds would offer that opportunity for somebody who's willing to move a little more into bonds.
What about moving money outside the U.S. market? Are there any regions that attract your attention right now or look promising?
Yeah, so we've been pretty dour on markets outside the United States. We feel that the United States has clearly led the way in terms of growth, innovation, AI. It's just been the United States has been really the leader in the global economy for the last 10 or 15 years. But when you look at Europe, you've got growth rates that are stuck below 2%, dealing with energy problems, and of course the war in Ukraine. You look at China, you've got structural problems, you've got debt problems, and you've got an economy that's just basically forced to run at a speed that it fundamentally can't sustain for a very long period of time. So you've got risks in both places. I would say we're probably a little better off taking a small amount of risk in emerging markets. And we're still waiting to see some kind of improvement in developed foreign markets from a U.S. perspective. So we're not seeing a lot of opportunity yet overseas, maybe a little bit in emerging markets, but we're still very, very cautious about for Europe, for example.
There's been a lot of speculation about what groups will do well under Donald Trump when he enters the White House, along with the Republicans in control of Congress. What are your thoughts there?
Well, okay. So the knee-jerk reaction would be to look at things like energy. One of the policies that the Trump administration is looking to move aggressively on is energy production here in the United States. So energy would be a place where maybe there's an opportunity, but ultimately, a lot of that stuff, a lot of commodity prices are set in global markets, and higher prices tend to beget more supply, which becomes an issue for the rally in the first place. Ultimately, we would tend to stay with groups that are more consistent. We like the consumer. We like healthcare, technology on a pullback for sure here in the United States. Those would be the areas where we'd be looking to park some money.